Ajal Irani to talk a little bit about the big rejig that Reliance Industries has taken as when it comes to their overall digital foray. And by and large, Jal, it's being viewed at very positively, saying that, this new company that will be set up for Deere's digital services is going to, all in all, create a lot of shareholder value in the long run. Just take us through how you believe, this is likely to benefit the overall company.
I think firstly, Reliance Industries as a whole is in the process of creating various verticals, various distinct verticals within which there is clarity and hence easier for them to bring in strategic partners. And that is in the process of triggering value. In a slightly different way, to draw a parallel, what had happened in 2005, 2006, when we had sort of seen similar verticals sort of get clearly demarcated and then split out. Essentially, there was a 38% value enhancement for shareholders at that period of time. Now, specifically in the case of this rejig, essentially the expansion within the digital / connectivity space has been very rapid, and what Reliance is attempting to do is really specifically demarcated into two separate verticals. One is the technology / digital vertical, in which you'll have the 8 odd leading apps that they have got. You've got the technology bit, things like Internet of Things, cloud-based facilities, and within this one vertical, they'll also have basically the 200 odd investments that they made in Den and Hathway. Do note that the other media bit will remain outside this. So this is the first vertical where Reliance Industries will have a direct 100% holding. They call it WOS, basically a wholly owned subsidiary. And this wholly owned subsidiary then in turn will have a 100% stake into the connectivity business. The connectivity business is threefold. The first part is the mobile connectivity, which, as you know, has already got 355 odd million customers. And the second two bits will be the broadband enterprise and home, which they've just launched. So it's a step down structure. Firstly, you'll have the wholly owned subsidiary, which is the technology bit, and that wholly owned subsidiary will own 100% of the connectivity / telecom business. So they have basically given clarity that other than media, which remains outside, these are the two main subsidiaries. Now, once they've created this clarity, then they are essentially in the process of scouting around, inducting a strategic partner at, I understand, the WOS level, the wholly owned subsidiary level. And their belief is that essentially the global majors in this space not only like a clean structure, but a debt-free structure. So what they have also done is that they have transferred 108,000 crores of debt from the subsidiaries to the parent, the standalone Reliance entity, and Reliance Industries to that extent has subscribed to optionally convertible bonds basically into these step down subsidiaries. The consolidated debt for the entire consolidated entity does not change. So basically a clearer structure, and which makes it easier for strategic investors to come in.
Okay, that's the overall view coming in on Reliance Industries. I just wanted to also get in a take as to what you're making, if I may deviate for a moment, to some of the other oil marketing companies as well in general. There has been a lot of interest. Incidentally, BPCL has been one of the best performing stocks this year. With the government divestment agenda as well on in full focus, do you see strong upside potential within these names? And, what kind of target prices are you assigning here?
Well, we do believe that the entire space is actually very competitive in the country. So India has got one of the lowest cost refining bases in the world. The operating cost per barrel in India is barely $2 per barrel, versus the global range is global range goes as much as $6 and even above. So the entire space is very competitive, and in fact, because of its competitiveness, the Indian refiners are in the process of enhancing this competitiveness further. So as you are well aware that within the product slate, diesel crack spreads are in the process of going up, and fuel oil, which is bottom of the barrel, is going down. So the Indian refiners are actually changing the product slate to produce more of the higher margin business, and therefore they're becoming even more competitive. The second thing is that globally, while there's a bit of an overcapacity in the near term, in the medium term, in roughly about 2 years, we are poised to see a very significant boom, because global capacity increases are tapering off very sharply because it's very expensive to set up new capacities. And therefore, for these two reasons, that is both India's competitiveness increasing as well as a global refining boom after 2 years, we think that the entire space is very competitive.
Okay. With respect to Reliance Industries, just going back to that, from moving now for the company from a telecom service provider to a digital powerhouse, how do you see the disruption within a space that's now already getting very crowded?
Well, I'm not too sure if I'd call it crowded at all. If you look at the Indian ecosystem, there is really a handful of companies in the space which are positioned there, unlike an Alibaba, JD.com in the US, in China, and the likes of Amazon globally. So actually, India is in a very nascent stage, and if you look at, although not sort of digital in its entire form, but if you look at sort of connectivity, the consumer space, the unorganized market is 10 times larger than the organized market, and Reliance is really in the process of not only grabbing a significant share in the organized market, but it is in the process of rolling out tools where actually it goes after the unorganized market, which is much larger. So in several ways, I think barely competition, and even Reliance has barely scratched the surface in this space. So the opportunities can be very significant across the board.
That's clearly the take that's coming in. What I was just referring to is that now there are a lot of players that we're seeing that are beefing up their OTT plans and, really looking at this space quite aggressively. But other than that, then let's just get in a call as to what your recommendation is on Reliance Industries. We have a lot of brokerages hailing this as one of the best bets within the space. They're upping their target price and all in all remain fairly positive. Do you share that optimism?
Yes, indeed, I do. Just a clarification, I think if you're talking about the OTT space, you are perhaps right, and that sits in the media business, which just to clarify, the media business is not part of this entire sort of digital restructuring plan that they are talking about. So that's a different space altogether, and you're perhaps right on that front. I think beyond, so indeed, I think Reliance is the stock has done very well, and we are actually very positive. There are other bits and pieces that or other significant developments, i.e. Reliance going from actually reducing its debt dramatically, which reduces its risk also significantly, and also Its capital expenditure, even in the latest quarter, has come out dramatically. So it's spent more than $60 billion over the last few years, and a lot of the earnings growth is going to come from the $60 billion. We're looking at a 15% CAGR earnings growth over the next five years from the capex that they've already done. So for all practical purposes, it is correct for brokerages to be actually very bullish on Reliance Industries.
Joining us this morning, Joel. Always is a pleasure to get your perspective on these major developments. So